It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
We just had to redo this opening because I thought it was the second hour. It's the first hour. Welcome to the program. I guess I have a little hangover and from my holidays. Unbelievable. Anyway, welcome. It is the Jill on Money program. It is post-Christmas, very end of Hanukkah, almost New Year's. We are delighted that you're joining us. It is a time that we reflect on the year that was. We look forward to what's coming up. We also try to make financial changes in our lives. You remember when we, hey, Mark, did we have Dan Pink, the When book? We had him on the show, right? He wrote this book, When, and I remember asking him about financial resolutions and New Year's, and he said, actually, those key dates are very good dates to prompt you to do something different in your life. I always thought that was nonsense, but I think it's true. And so I'm going to encourage you to do that, to give us a holler, to make sure that you use this time wisely. How about that? If you'd like to get in touch with us, just send an email. It's askjill@jillonmoney.com, askjill@jillonmoney.com. That is what Mario did. Mario is from Colorado. Welcome to the program. What can I do for you, Mario?
Hello, Jill. Thank you for taking my call. A little nervous here. I've never done this before, so help me through it, please.
You know what? I am here. Just talk to me. Don't talk to the zillions of people listening. I'm just kidding. It's just us. We're just talking. Nothing bad's going to happen. So tell me, Mario, what is going on and how I can help?
Well, I guess we'll get to the point where, we're thinking retirement. I've worked all my life, and I have a hard time with that word, but financially and the way things are going in my sector of the world, I have to look at this pretty hard now. I have been a farmer in my life here, and things have not been good for farmers lately here in this economy.
Mm-hmm.
And with my investments that I have and some liabilities, I just better take a different approach.
Okay, that makes sense to me. It's been a heck of a year, heck of a 19 or 20 months for farmers in this country. Mario, what's your crop?
Well, I raise sugar beets, corn, pinto beans, wheat.
Mm-hmm. Okay. So, first of all, how old are you?
I'm 62.
Okay. Are you married?
Yes.
Okay.
My wife is also 62.
Okay, great. And are both of you active in the business, the farming business?
Yeah. Well, I am. I run the farm, and she runs the show at home. So.
God, yeah. Well, then she's got a big job there, right?
Yes, she does.
Okay, so you've saved a bunch of money, but I presume a lot of let's just say this. The farm itself has a value. What is the value of the farm itself?
Well, I'll tell you what had happened was back in '06, I had the farm. I had a 160-acre farm, and times at that time were getting a little rough, too, and my wife was teaching at the time, and her health went for the worse for a time there, and so it was actually a time here in Colorado where it was, in this area anyway, you could really capitalize on if you had sales. So I did sell the farm. I kept 10 acres, and I've got some water shares yet that are very valuable. And I've got 3 homes on this 10 acres that I have 3 children, and that's been our lifetime goal, is to leave something for our children.
Wow.
That's our legacy.
That's amazing. So you have 10 acres.
I have 10 acres.
And
now.
what is there any mortgage against the 10 acres?
Well, just on the one lot, I've got the mortgage on this home, this last home we built.
Mm-hmm.
of about $312,000.
Okay. And that's just against your primary residence, right?
Correct.
Okay. How much is the primary residence worth?
Probably right now in this area, upward of $900,000.
Okay, great. And the other two homes, are any of your kids living in those?
Yes, they are.
Okay. And have you already gifted those to them, or will they inherit those?
Right now, I have a plan for them to be inherited.
Okay, good. I think that's better because then they'll get the step up in cost basis. So that's much better. Okay. So we got the housing. Okay, we got that. We got the farm. Tell me about the water. What's the water valuation?
The water valuation that I own, or we own, is about $1.2 million.
That's amazing. And is that, like, if you wanted to sell that, is there a fairly liquid market for that? Could you go and sell that easily?
Yes.
Okay. Just want to make sure. What do you think the cost basis is of that? I mean, I presume you've owned that for a long time, right?
Yes. On an average, I guess the cost basis would have been $80,000.
Oh my God! So you're going to get hammered on it. If you sell it, you get hammered because of taxes. But whatever, so be it, right?
Right.
Okay. What about money outside of the farm? Liquid assets of any size. I mean, not liquid, but just like what's not tied up in the farm.
For, I guess, investment assets.
Yep.
I've got we have a couple annuities worth about $109,000.
Okay.
And some REITs about $70,000, $71,000, somewhere in there.
Mm-hmm.
I also have on me term life insurance of $400,000. And that was, if something happened to me, it'd pay the mortgage.
Right.
Was my thought there.
Sure.
And I have a money market that is set up to pay on that.
Okay.
On a semi-annual or quarterly basis. I can't remember right now.
Okay. Okay. So the investment assets, $109,000 annuities, $70,000 in the REITs, the term life. Anything else? Any retirement accounts?
No, just the annuities and the REITs.
Mm-hmm. And the REITs, I'm sorry, the annuities, you said $109,000. Is that $109,000 in one, or is it for each of you? Each of you have an annuity?
That's a total.
Okay, got it. So what we base, and is that it for, like, what about cash in the bank?
Yeah, right now there's, I got a CD and checking account. Probably $45,000.
Okay, so that's good. So when we come back, we're going to figure out how to help Mario crunch these numbers and consider what the next steps could be. It's an interesting situation because he does have the opportunity to make his life a lot easier, and that's what we like. You're listening to Jill on Money. When we return, Mario the farmer is going to figure out where we go next with his retirement. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. Before we went to the break, we were talking to Mario from Colorado, who is thinking about retirement. He and his wife are 62 years old. They are farmers. And it strikes me, Mario, that you're in pretty good shape here because you've got assets. We've just got to make them liquid. We've got to figure out how to get the money working for you so that you don't have to worry about how you're going to pay your bills. So one question that I have for you is this. How much, if you were to retire, let's say this year, next year, a couple of years, whatever, what do you think you need in terms of income to live on?
I guess if I consider the mortgage payment, I'd probably have to have $45,000 a year.
Okay, great. And you mentioned briefly that your wife was a teacher. Is she entitled to any pension benefits?
We turned that into REIT, into an annuity.
Okay, got it. And your Social Security, not at age 62, but at your full retirement age, what is the Social Security benefit for you?
So
it should be like at 66 or 67, it'll say.
Right.
Yeah.
Right. 18,660.
18,660. All right, 18.
For me, yes.
And she'll get half of that, or will she claim on her own record?
Yeah, she got 9.
Yeah, so it's half of that. Yep, got it. Okay, so when you look at your needs, right, we say you have about 20, let's call it 28 grand of your 45 that would come in through Social Security. So we need to create another $20,000, which is okay because, again, you've got a couple $100,000 between the annuities and the REITs, but you got those water shares, which we got to sell because because it won't pay. It may be that if you held on to the water shares, they would increase in value, but we need them to create income for you. So if I looked at the water shares plus your other assets, I think that you're probably you're in good shape. So I think that what has to happen, essentially, like big picture, is you probably can do, you probably are going to be fine for your retirement because if we get those water shares, you pay the tax that's due, okay? You're going to have to pay the tax. There's no way around it. And let's just say that you end up with $1 million after paying taxes. You've got another couple $100,000, so you got $1.2 million. Was there any other outstanding debt besides the $312,000 on your mortgage, on your primary?
Yeah, there's some farm debt yet. Well, you know what I forgot to mention? On the farm debt, there's probably another $130,000 on debt.
Uh-huh.
And then the farm equipment is an asset, which why'd I space that out? I don't know. But conservatively, if I sold it, I would say $200,000.
Oh, so if you sold the equipment, you could pay off the debt. So I'm not really worried about that. All right. So here's the thing. This is what it looks like to me. Big picture, and then we'll go into a little bit more detail. Big picture, you're in good shape. You can have $1.2 million, right? You don't need to generate that much money from it. You'll be able to generate, let's call it, I don't know, 35 grand a year from those assets. You add that to your Social Security, you're done. It works. Okay? So that's the good news. Now, the what to do with the money once you sell the water shares is a different question. And I think that someone's going to tell you, oh, I can invest it for you, right? You've seen a couple of different people who can help you with the investment part of it. Tell me what you've done so far.
Yes, well, I've worked with a financial planner on when we sold the farm and tried to put these things in play. We did get hurt financially in the 2008 deal. They put us into the ticks, and that blew up. Somehow I was able to survive up to this point. And their thoughts are selling some of the water shares and putting them into annuities.
Don't do that.
You're right. And then I talked to another financial planner just because I wasn't quite
comfortable
that way.
Yeah.
He thought maybe sell one at a time and put it in maybe some mutual funds or something like that.
Yeah. I think that we need to get you a financial planner who can look at your big picture and then be able to recommend something broadly, and a strategy, not a product, okay? Because what I'm hearing from these people is, here's what I would do with your money, as opposed to, hey, Mario, here's how we should be thinking about your retirement. And what I would like to do is I am going to connect you with some people who do fiduciary financial advice, okay? They're going to hook you up with somebody. You can talk on the phone with somebody. You can just get a sense of this. You can tell the same story again. I don't want you to just plow ahead. Get it? Plow? Farmer joke. I don't want you to plow ahead with somebody's just going to sell you something. You need a game plan. And to get that game plan, that requires somebody who's going to have these kinds of conversations that I'm having with you, come up with a strategy, and then give you some advice. So you know what? Let's Mark. Let's send Mario a couple of names of people. You don't have to do this with live somebody in person. You can just do it, on the phone with somebody. We'll give you a couple names of people who can take care of you. You can pay them a flat fee to do some planning work. And then they'll come up with a game plan. If you choose to use those people, then they might waive the fee or credit it against whatever you're doing. But you know what the most important thing is? You will need advice. You don't need a product. And what you definitely don't need is another annuity. And that's for sure. What I think is important for you and your wife to consider is that you're doing this exactly as you should be doing it. You are saying, hey, it's a tough time to be a farmer. We've been doing this a long time. We've got this. We've got our house. We've got this equipment. We've got these water shares. We have an opportunity. What should we be thinking about? And while you're still making money and making this work, this is the time to really come up with a smart plan, not to buy a thing. See, this is always my complaint about the financial services industry. Every time they have a conversation with somebody like Mario and suggest that Mario buy something, when in fact what Mario needs is advice. That's it. And then if the way to get the advice or create the strategy, the way to achieve the financial goals that have been set out is to do something, it should be something in Mario and his wife's best interest. And I just don't think that another annuity is the way to actually achieve the goals. I would also point out, and Mark, you may find this interesting as well, that here's somebody who has illiquid assets, right? Mario and his wife own property, 10 acres, houses, water shares. Whoever sold the annuities and the REITs then piled on more tangible assets with the REITs and an illiquid asset with an annuity. I just don't think that's great advice. So I have a feeling, Mario, that you don't have an advisor. You have a salesperson. Hey, I love salespeople. It's great. But I don't like it when they pretend to be giving advice that's in the best interest of the clients. So I think what we're going to do, Mark, is we're going to give him a couple names. I have some ideas. I'll talk to Mark off air. He'll follow up with you, Mario. We're going to give you some people to talk to who I know will take care of what you are asking for, which is cultivating a game plan. That's the most important thing. Cultivating a game plan, then executing the game plan is the second step. Does that make sense? I hope so. All right, hang on, Mario. Mark will be with you in a second. I promise you we'll give you someone who's going to be able to do this. All right. I got fired up on that one, Mark. It's Jill on Money. If you've got a financial question, maybe you're like Mario. Give us a shout. Ask Jill at jillonmoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And yes, Christmas is behind you. But maybe you're still in the middle of Hanukkah. Depends when you listen to this. Maybe you're just gearing up for New Year's. You know, I once went to a wedding on New Year's Eve. It was fabulous. It was like someone throwing this awesome party. And I didn't have to worry about anything. It's kind of a genius move, if you ask me. All right, here's an email from Lou, who's got $350,000 in a Schwab investment account, $450,000 in Fidelity. They're both similarly invested, split by low, medium, and a bit in higher risk. I want to move everything to Schwab so it's all in one place. Is it better to keep two accounts? No. Move it to Schwab. It's easier to manage. And I think that I presume, I'm not going to say that it's a definite. You may have to keep some of these investments, but some you might have to sell. Should make sure. Let me do this. Let me rephrase this. First, let's find out whether Schwab can hold everything that's at Fidelity. That's really the main thing. Or is this move going to trigger a tax event? That's the one thing we want to know. But otherwise, I'm all in for consolidation, easier to manage, much better. Hi, Jill. This is Diane who's writing. I'm a 60-year-old fan of your podcast. I need clarification on what is considered earned income by the IRS so that I don't exceed the cap on income that I'm now collecting for the Social Security survivor's benefit. Specifically, I collect $15,000 of rental income through Airbnb. Well, that is not earned income, so don't worry. I would also like to start converting $40,000 annually from my 401k to a Roth. Will the $40,000, which I will convert, go against the earnings cap? I'm going to guess yes. I don't know the answer to that, but I'm pretty sure because I think that it triggers. So let's just think about what it is. It's money that hasn't been taxed that you earned, right? You earned it previously. It hasn't yet been taxed. I believe that when you start converting, that this will go against the earnings cap. What do you think, Mark? You trying to research that? I'm just guessing. I think I'm right, too. So I'm going to say that's earned income. Sometimes when you start noodling around these things, you just think about, well, what was the source of the funds? That's a very good way to start, right? Then you go to, okay, well, as we go through this, like, well, what's the next thing that comes up, right? That's often how I solve many financial problems. I just think about like, okay, what was this? What is this treated as, etc. Candace writes, I'm about to retire from Boeing, and I need to choose between the pension annuity or the lump sum payment. I don't have children, not concerned with leaving an inheritance. I had decided to take the annuity, but then I read an article about Boeing's pension being underfunded. Over 30 years, the annuity option would pay approximately $900,000. The lump sum I'm offered now is around $300,000. Can you provide insight on the health of Boeing's pension fund? It would be of great interest to those of us in the states of Washington and Missouri. Candace. Okay. I think there's two issues. I don't know the exact, whether Boeing, they may be underfunded, but once you actually are retired, you're much more likely. When they're underfunded, they usually screw the newer workers, not the people who have already retired. So that's number one. Number two, I don't know by how much they're underfunded, but it is highly unlikely that a company like Boeing would just blow up and screw all the retired people who have already started receiving their benefit. That said, the nice thing about getting the lump sum is that, you don't have that risk at all, but you do have to actually invest the money yourself. I'll tell you what I might do. I might go talk to a financial planner, a fiduciary planner in your area who's familiar with the pension fund there and get a unbiased opinion. I'm sort of going with the. I think it's probably going to be fine to do the annuity, but I don't want to go out on a limb. This is all the money you have in the world, especially. So I would get a second opinion from somebody there who's really studied it, and I haven't studied it. So let's be clear about that. Okay, Beth is 66, retired last year. Bulk of my retirement savings still in my 401k in the stable value fund. What's your opinion about leaving it there? Better to roll to an IRA? The bulk of it is pre-tax money. I realize that this is not guaranteed in the stable value fund. I guess that's what bothers me. Well, it may not be guaranteed, but it's pretty safe. If you're allowed to leave it there and it's a cheap fund, then that's no problem. Rolling it over will give you more options. You could roll it over to lots of different places where you could get invested in perhaps a short-term bond fund or a money market fund. But I don't really necessarily think it's the worst thing in the world to leave it there. I guess the question is why you're 100% in no risk and whether that's going to be okay for you. Don't forget that stable value fund, guess what? After you actually factor in that you're going to have to pay taxes on it and you factor in the rate of inflation, you may not even be making money. You might be barely breaking even or even potentially losing money. I'd hate for that to happen for you. I really would. So maybe we should consider alternatives for you. And if you need some alternatives, we'd be happy to assist you. All you have to do is just send us some follow-up information. All right? All right, there we go. There's a segment in the can. If you have a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. Askjill@jillonmoney.com. Hey, go on to the website right now, and you can buy my book, The Dumb Things Smart People Do With Their Money. What a good way to start the new year on a strong footing. Get that book. Avoid those dumb things. We'll find you 13 ways to right your financial wrongs. All right, it's Jill on Money. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You are back. It's Jill on Money. If you've got a financial question, we'd love to hear from you. Mark is really kicking my butt trying to get these emails cleaned up before the end of the year. So let's get right into it. This is from Lydia, who wants to know, does a 15-year mortgage make sense? My family and I moved to North Carolina for a job change. We sold our home in New Jersey. We've been renting while getting our bearings. I think that's such a good idea. Okay, thinking about buying a home in the next 6 months. I'm 43, my husband's 45. I thought it might make sense to consider a 15-year fixed-rate mortgage so that we could be done with the debt by the time we retire. We do not currently have any other debt. We've got a good start on college savings for our child, one child, 13 years old. I've got other questions related to the move. Do we need to redo wills and term insurance? But most interested in your thoughts on whether a 15-year mortgage is a reasonable thought. Hey, look, it's a reasonable thought, but it may not be a good thought. It's certainly reasonable to consider, but here's what I think. You got a 13-year-old. You didn't mention what you were doing for retirement. You didn't mention how much money you have saved. My theory in life is you want to start with a nice, low 30-year fixed-rate mortgage, and you got low rates. Keep it in place. If you want to pay it off sooner, you could, but I have a feeling you've got other priorities that are going on. So I think it's okay. I just wonder whether your money could be deployed more efficiently doing other things like saving for retirement, saving for college. So I need a few more details before really weighing in with 100% certainty. But I think that generally speaking, I'd like the 30-year because it gives you flexibility. In terms of wills, you don't have to redo anything. You should have an estate attorney from North Carolina just review what you have to make sure that there's no state-specific rule that is going on. But that's it. You don't need insurance, no. If you think you might need a financial advisor down there, then that's something different, but certainly should be just fine, okay? Okay, John writes, my wife, 64, wants to move $280,000 from an employer plan with Prudential to an annuity plan with Fidelity with a private financial planner away from potential loss of stock market. She's got $200,000 with the financial planner who says he or she says he is a fiduciary. His fees are 1.5% annually. He wants to transfer $280,000 to TD Ameritrade. Discuss options for annuities with Fidelity. Would it be more prudent to simply visit a Fidelity office and set up a safe income-producing account? I'm retired with government pension. I've been assigned this task by her. She has no time to do it, plans to retire at her Social Security full retirement age. You know what I would do? Let's stand down for a second. If she's got $200,000 and she does not want to have any losses, maybe we could just make this a lot simpler and say, well, she could potentially, instead of having an annuity, which has a lot of costs involved, maybe she should just be buying a couple of bond funds and calling it a day. Maybe she should check out a different advice model, because at 1.5% plus the annuity sounds to me like she's going to end up paying a lot of fees. So this person might be a fiduciary financial planner, maybe. Although having an annuity with her retirement plan assets, it's hard for me to believe that person's a fiduciary, but maybe that person is. I need more information. And you know what, John? I would do nothing right now. I certainly wouldn't be putting the money into an annuity. But follow up with me. Let's try. Can we get John on the air? Mark tried to get him on the air. This is when I need you on the air, because if I don't have you on the air, it's hard for me to ask these follow-up questions. You see, I'm a pain in the neck, but. All right. This is from Tim, who says, one of the biggest roadblocks to a decent retirement in the state in which I live is the public pension system, which is outrageous. It burdens homeowners. I pay $11,000 a year in property taxes for a modest home. Pension reform is needed to reduce property taxes. It's time for 401ks to take the place of taxpayer-funded pensions. Easy for you to say, Tim. I don't know about that. I probably disagree. I don't think that the pension system needs to be reformed because you have like an underfunded pension in many places. But you think that municipal workers, I'll tell you what, if you're willing to pay more, the same amount in taxes to give the police people, the firefighters, the garbage pickup, the teachers, as long as you're willing to pay them higher wages, then sure. I think that's a silly thing. By the way, if you don't want to pay your property taxes, then go move someplace without property taxes. You could see I can get on my high horse about this. Okay. This is someone who says an extra Social Security benefit is due to expire at the end of 2019. I have no idea what that is. Mark, do you have any idea what that is? Something that was heard? I don't know. I don't know what that is. I'll have to, we'll dig into that a little bit. All right. All right. When we return, we're going to get back to more of your questions. Again, our email address is askjill@jillonmoney.com. We'll be right back. You're back. It's Jill on Money. We are broadcasting live from the Capital One studios. Capital One, what's in your wallet? If you've got a financial question, we'd love to hear from you. Just send us an email, askjill@jillonmoney.com, or you could be on the website, jillonmoney.com. Click on the contact button. That will bring you to us, just like magic. Mark has set it all up. All right. Before we finish out this hour, let's get to a couple more questions. Tom writes that he got a CD last December, and it's paying 2.67%. It matures in January. Unfortunately, interest has dropped down. Wow. This is what happens when you get the Federal Reserve cutting interest rates 3 times, right? Anyway, he says the interest so he's going from 2.67 and now the interest rate 0.75 for a similar CD. Okay, I listened to your show on WBEN in Buffalo. Love Buffalo. And he said, my story would kill you if you heard it. I get by with $1,300 a month. I own my home. I've got $68,000 in the bank and this one $15,000 CD. My IRA has $70,000 in it. I'm 62. I'm happy. But miss my girl who I lost last November. It's funny to hear how much money people have in the bank. I worked for 40 years, but I'm visually impaired, so I don't make enough to be rich. However, I do get by. Thanks for any info. Love, Tom in Buffalo. Tom. Well, Tom, here's an idea. You can go to a different type of institution. You might get more money. So there are these online places, and they have much better interest rate perhaps than your brick and mortar bank. Go check out this website. It's called depositaccounts.com. Depositaccounts.com. And there you can see if there are other CDs. If you have a credit unions can also offer good CD rates. But I think that you'll probably do better than 0.75. Okay? That's it. That's all the time I got. It's the end of hour one. We have a whole nother hour. Don't forget. Hey, during the break, go to the website, JillOnMoney.com. You can buy my book, The Dumb Things Smart People Do With Their Money. And you can sign up for our free weekly newsletter. Go check it out. Jill on Money. All right. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of Jill on Money. We are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Fantastic. All right, so here's the thing. It's a time of year where we often see our relatives, right? We get together, there's family gatherings, and maybe you don't even see them physically, but you talk a little bit more. You're in conversation. What an excellent time to start to open the door to have difficult conversations about money. We were thinking about this as we were booking this next guest, Cameron Huddleston, who is a personal finance journalist. She wrote a book called Mom and Dad, We Need to Talk. And we're bringing her on the program because not that I want you to say, oh, can I have another piece of lasagna, Mom? How much money do you have in the bank? But to start opening up these conversations with your family members so that this acts as almost a prompt for you. So check it out. Here's our interview with Cameron Huddleston. Okay, so your new book, Mom and Dad, We Need to Talk, How to Have Essential Conversations with Your Parents About Their Finances is out. And you start the book with one of my favorite surveys from care.com. More than half of parents would rather have the sex talk with their kids than talk to their parents about money and aging issues. Why do you think that is?
Well, we know that both sex and money are taboo topics. But I think there are several reasons why adult children are so afraid to have these conversations. They're afraid their parents are going to think they're being nosy, they're being greedy, that it's none of their business, and that if they bring this topic up, it's going to make their parents mad and hurt their relationship.
You come from a very personal story about your own mom. So would you mind sharing that with us?
Sure. So when I moved back to Kentucky and my mom was about 60 years old, I mentioned to her that she should look into getting long-term care insurance. I didn't beat around the bush. I just came out and said it because she and my father were divorced. She was on her own, and I knew that if she had any long-term care needs in the future, that long-term care insurance would help cover those
Hold
costs.
on, I gotta be nosy here. So how old were you when they got divorced?
I was in college
Oh, so
when my parents got divorced. So
and-
she had been on her own for a while.
okay. And when she was divorced, did she talk about her money stuff at that time? Because you're older, so was there pressure? Was it all of a sudden like, oh my God, my parents are getting divorced, I can't afford to go to college anymore? Because that happens to kids.
Fortunately, my parents both continued to help support me through college. It wasn't so much of an issue. My father was always, you don't talk about money. It is impolite. You don't ever talk about money. My mother, it wasn't such a big deal with her. We didn't talk about it openly, but she didn't act as if it was a taboo topic.
Okay, so that's helpful.
Yes, it was helpful. And I think maybe because I was a personal finance journalist when I moved back home, and I still am, she listened to my advice. And so she went to meet with an insurance agent. But unfortunately, she had a pre-existing health condition.
Okay.
That made her too much of a risk to qualify.
Did you only find out about that because of the underwriting process?
And we already knew about that.
Okay.
It's a benign tumor that was behind her left ear that had caused hearing loss. So if I had been smart, I would have taken that opportunity to start talking to her about her finances, to say, Mom, you don't qualify for long-term care insurance. Let's look at your finances, see where you stand, see what sort of care you could afford on your own, and let's talk about the care you would want.
What are you thinking in that moment? Can you go back in time? Like, she didn't get it, that too bad.
She didn't get it, too bad.
She's young.
She's relatively young, and I look back at that and I see that I made a big mistake. It was a great opportunity to start talking to her. And then, of course, what would happen a few years later, I start noticing that she's having trouble remembering things. But then at that point, it's no longer a conversation about what if this happens, Mom, but this is actually happening. And so I was afraid at that point to talk to her about her finances because it meant pointing out to her that we're having the conversation because I can see that she has memory problems.
So then what happens? I mean, she's now showing some signs of something. You don't know exactly what it is.
Yes. It became obvious, though, that it was
Cognitive.
probably the early stages of dementia. And
She's so young.
She was so young. She was, I would say at that point, maybe around 64.
Wow.
And it got to the point where I realized, okay, I can't stall. I cannot put this conversation off anymore. And so what I said to her was, let's go meet with an attorney and update your legal documents, your will, your living will, which is also called an advanced healthcare directive in some places, and her power of attorney. I knew that she probably had not updated those since she had gotten divorced from my father, and I knew that those documents were so important because you had to be mentally competent to sign them. And fortunately, she still was. She was still competent enough to sign those documents.
Do you have siblings?
I do. I have a younger sister. She lives far away from us, and so really it was me.
Okay, you get that buckled down.
Yes.
Now what about the money?
Meeting with the attorney was a really smart move for a couple reasons. First of all, we get everything squared away with her documents because if my mother had not named me power of attorney before her Alzheimer's, which is what she was diagnosed with, really progressed, I would not have been able to step in and start managing her finances. And I don't think most people realize this. They think, if something happens to mom and dad, they have a stroke, for example, they're in the hospital, they have to write checks from mom and dad's account to pay the bills. They can't do that.
Right.
Unless mom and dad have already named you power of attorney. You can't talk to the doctors about their health care unless they've named you their health care surrogate or power of attorney. And so people don't realize that without these documents,
You're kind of stuck.
you're kind of stuck. You're really stuck, and the alternative is to go through the court system.
Right, you
and
have
spend
conservatorship.
thousands of dollars in
Terrible.
months. No, it's awful.
Oh, God.
It's awful. And so meeting with the attorney, she pointed us in the right direction. She said, you need to go to your mother's bank and put me on the account as her representative payee. She walked us through some other steps to take. And then I slowly started stepping in because she was still doing relatively well, just having issues with short-term memory. You don't want to just go in and start taking over.
Mm-hmm.
And that is not at all what my book is about. It's not about talking to your parents so you can tell them what they're doing wrong or take over their finances. It's about having these conversations before things like my mom's situation arise, so you can talk about the hypotheticals. You can make sure the legal documents are there so that if you have to step in and help, you can.
So if you want to start having these conversations, I thought that you had this really great section about how you approach this. And you write, it might seem like I'm wagging my finger at you here, but the goal is to get your parents talking. Here's what you shouldn't do. And you start with don't use you language. What does that mean?
So that means the conversation is not about you. It's about your parents. And for any of your listeners who are in a relationship, and when you get mad at your partner and then you come at them and you say, I hate it when you do this. And of course, they become defensive. And so if you're going to talk to your parents about this, you don't want to come to them and say, you need to do this. You're getting scammed. You're getting taken advantage of things. You want to come to them saying, I am concerned. I would like to know. It would give me peace of mind if we could have this conversation. It's about you, but you looking out for your parents.
We'll get back to our interview with Cameron Huddleston in just a minute. Hey, you know what? While you're in the break, why not hit the website, JillOnMoney.com, and there you can buy my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. And guess what? I have a whole chapter about dealing with your parents as they age. So check it out, JillOnMoney.com. We'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. It's the holiday season. Hope you're taking some time off, recharging your batteries, getting back in touch with your friends, your family members who you haven't spoken to. We are, it's funny. In this age, we're totally in touch, but so rarely do we have real conversations. That's what I think is missing. That it's so easy to send a quick note or a press like on Facebook. It's so easy to do that. It's so much harder to have an in-depth and meaningful conversation with people that you love. And that is what we're talking about with our guest. She is Cameron Huddleston. She is a personal finance journalist, and she's written a book about how to talk to your parents about money. Now, this may not be the favorite topic of anybody. I understand that. But if you have meaningful conversations with your aging relatives while they're still well, you will find that so much of the future is easier to navigate. The key, of course, is to have the conversation. The next piece of this is, when is the best time to have the conversation? That's what we're talking about with Cameron Huddleston. And you really have to be clear about when you want to have these conversations. And you note, and I think you even just said this, that you want to take advantage of an opportunity as it arises. So you don't want to wait till something cataclysmic has happened. So in your case, it might have been, okay, the underwriting shows you're not going to get long-term care. Let's use this opportunity. What are other good points to maybe use as the when to have a conversation moment?
So when maybe your parents have already retired and maybe they're complaining about how they're not getting to travel as much as they wanted to. So don't just write that off as, oh, that's too bad for mom and dad. They're not getting to do what they wanted to do in retirement.
Why is that?
Start asking questions. Oh, why not? And then you might find out, well, maybe they haven't saved enough. But you can use that as an opportunity to very politely kind of suggest, I have some great ideas on ways you can save on travel. And then let that lead to other conversations. The thing is, you don't want to start bombarding them with questions all at once. When you find your way in, point out to them that you would like to talk about this more. And then ask them, can we find a time to sit down and do this? And it might take several conversations, but you don't really want to catch them out of the blue. You can use a moment to get the topic started, to get the conversation started, but don't suddenly start grilling them about their finances.
I have noticed with my own mother that she will open the door in a way that if you want to walk through, you can go through. And what I think a lot of people find this, that she talks about friends of hers. Oh, it's so horrible. Barbara has to now go from assisted living to like actual real nursing care. Then I say, what would you want if that happened to you? Would you want us to have like 24/7 care in your apartment? Would you want to be in a facility? How do you think about that? I have to tell you something. My mother, who's incredibly social, she'll like play bridge anywhere there's a bridge. I would always think if she could be in a facility where she could play bridge, 24 hours a day and just be able to always get a game, that she would choose that. And I was surprised when she said, I don't think I'd want to be in a facility. I don't like eating with people. Like, I don't want like mandatory, you have to eat with these people. I said, but what about the whole bridge thing? She's like, well, I guess I'd want to be able to have people to come to my place and still play bridge. But like, I don't know if I'd really want that. And that was surprising to me because I really think of her. I mean, on one hand, she's incredibly social, but I guess what she is raising is I'm also very private. And that's important to me. So it was just interesting because it was someone else and we could talk about it that way.
And stories are such a good way to start these conversations. So your mom had a story about her friend, which obviously led you to asking questions, but you might have stories you can share about your own friends. Friends who had a parent who died without a will, and it led to all this family fighting over who got what, or a friend who had to stop working to care for a parent, or maybe even a friend who had conversations or the parents are really open and kept them updated on their finances. And you can say, you know, my friend, Barbara, her mother been so good about giving her all this information about where her estate planning documents are and information about the passwords for her accounts so that if something happens to her, she can step in and help. And I love this mom because it's made things so easy for Barbara. Maybe we can do something like that.
Mm-hmm. And you also say that, you know, obviously life events, but talking about your own financial planning experience, how would that express, like, if we were having a conversation? So I'm your mother. So start the conversation. Let's do this. Mock.
So Mom, my husband and I recently met with an attorney so that we could have a will drafted and name a power of attorney and have a living will drafted. I just didn't realize how important these documents were, you know, and I want you to know that we did this because I want you to know we have these documents and we've put them in the, you know, in our home safe. And so if something happens to us, you know where to find them. Have you and Dad done this? Do you have these documents? Can you tell me where to find them? If
we have them.
You?
The lawyer has them.
The lawyer has them. Okay, well, can you give me the name of your attorney?
Oh, yeah, we'll do that. We'll do that. I don't want to do this right now. I don't want to talk about this.
Okay, that's fine. Then you know what? I'm going to send you an email and remind you. And then you can just tell me the name of your attorney and where those documents are in case I need them.
So the reason why I put that out there is that I think that sometimes these conversations, you're perfectly willing to go there, but either one of you have a hard time really thinking about what this conversation is about, which is now I'm talking about my death. And that's hard. And what you did is kind of brilliant. Like you back right off and you say, don't push this.
Don't push it.
Because that's bad. That's going to lead to an unhappy outcome for both. Let's say you send the email. I don't respond. You want to bring it up again? Like, how long do you want to wait? Because now this is like, now I presume as the child, you're like, uh-oh, where are these? Are these documents real? Is Mom, blowing smoke? It's hard to know.
Gently remind them. Again, when you happen to be on the phone or visiting Mom, oh, yeah, Mom, did you get that email that I sent? I don't want to sound like I'm nagging here. I just want to make sure that you have these things in place. And then maybe you use another story about things that did not go well for a friend whose parents didn't have these documents or they couldn't find them. Like you said, and like I said, don't push too hard, but don't give up either.
When do you have to give up? For real. There are people I know. I remember I was on vacation and someone found out what I did for a living. And they were telling me about their in-laws who were really resistant. And I said, did you try this? Did you try this? Yes. And she said, first of all, it's my husband's parents. So I don't want to push too hard. And he doesn't want to damage his relationship. He's really concerned. Just so happens the guy was a rabbi and the father was a rabbi. So there's a lot of anxiety in this whole family in general and respect issues and, I am your elder kind of thing. I said to her, look, you can only do what you can do. So when do you think you pull back and just wait again? Or how do you help people navigate that?
I agree that it does get to a point when there is only so much you can do. If you have tried a variety of approaches, if you tried to maybe get a third party involved, maybe a trusted family friend, a financial planner, an attorney, if you've tried, and if you've made it very clear that you want to gather some information from your parents because there might come a point when they might need your help and they've still resisted, then you do have to step back and say, okay, they're not going to talk to me. And this is especially important if you see that they might be having financial issues going forward. You might have to either A, start preparing your own finances to help them out, if that is something that you can do, because you don't want to jeopardize your own finances. But if you can set aside some money to help provide for their care. Or maybe you don't downsize because you know you're going to have to move mom and dad in with you. Prepare your finances or prepare yourself emotionally for the fact that you might have to say, when they come to you finally asking for help, I did try to have these conversations, and there's only so much I can do. There's only so much my own finances will allow. I have my own family. I want to be able to help you, but there are limits.
Thanks so much to Cameron Huddleston. And I know it's tough, but check it out. If you need some more help, just go out and get her book, Mom and Dad, We Need to Talk. Okay, it's Jill on Money. We'll be talking more with you in just a minute. During the break, hop onto the website, JillOnMoney.com. Sign up for our free weekly newsletter. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. Yeah. If you've got a financial question, shoot us an email. Ask Jill at JillOnMoney.com. That's what Bill did. He's a federal employee who plans to retire in about 7 years. He says, my retirement income will be from 3 sources: Social Security, federal pension, and the thrift savings plan. It's kind of like a 401k for federal workers. Okay, Bill goes on to say, I expect the 3 of these together will replace about 3/4 of my current income. My wife's Social Security should provide another 10%. That's kind of great. No mortgage. We do have one rental property that we own with a mortgage, but after debt service, it's cash flow positive. Okay, so here's the question. 98% of my thrift savings plan is in the 2030 target date fund. I wonder if I should continue to put 100% in the target date fund or split it into the G fund, which is a government bond fund. I was thinking that in retirement, I would pull funds from the G fund rather than from the 2030 fund. On the other hand, it may be too conservative. An approach, considering my family history, points towards a 30-plus year retirement. So I think it's fine to kind of go 50-50 if you want. It doesn't sound like you're going to have a big problem in terms of the amount of money. You need to pull some money out of this fund, but the 2030 fund is probably, has about a 50-50 allocation. I don't know if you need much more than that. I wouldn't. If you feel like you're a little nervous about the volatility of the market, then you can use the G fund. But I think you're fine in the 50-50 fund, to be honest. I don't think you need much more than that. So, especially when you're looking at the long term, you're not going to have to pull that much money out of these accounts. Okay, Kathy writes, I'm wondering if you could please help me decide if leaving my job would be feasible. I've been a loyal listener for years. I've been contemplating writing you for just as long. I'm 43, married with twin 14-year-olds. I'm eligible in 5 years to begin receiving my pension, as is my husband. Oh, my God, 2 people who get pensions. Mark, what are we missing? Okay, listen to this. So let's just think about this. When she's 48, she can get her pension. And she says at that time, our combined pensions will more than cover their living expenses. Wow. Here's the insight. My job has taken an immense toll on my health. I'd really like to leave it sooner if I'm able to do so, but only if it doesn't compromise our kiddos' futures. I'd love your opinion and advice. My husband is supportive and he will continue working. His income will cover living expenses over the next 5 years, although we may have to reduce savings to do so. Here we go. Combined salary, $200,000, cut in half if I leave the current employer. Retirement accounts, $950,000 combined, $900,000 pre-tax, $50,000 in the Roth. Roth IRAs on top of that $950,000, they got $300,000. Cash savings, $250,000. College savings, $140,000. Health savings account, $40,000. House, $500,000, $100,000 mortgage. Healthcare covered by employer until age 65. My concerns. I am at my highest earning years. Unfortunately, I couldn't have decided this when I was making half what I make now. I feel like it would have made it a much easier decision. We'd like to contribute 20 grand per kid, 40 grand total each year. They are in college, so a little short on that. Presently, our kids both work. They put their money in the Roth accounts. We match their earnings. I'd leave behind a $50,000 bonus, which I would receive if I made it to the next 5 years. I would still plan to work, though, in a different field part-time. My pay would be probably a sliver of my present income, just a quarter or so. We have no plans of ever touching our retirement accounts. Pensions will cover. What do you think? Can I walk away? Not quite yet. Any chance you could suggest a general asset allocation for these retirement accounts? Thank you for all you do. And congratulations, Mark, on passing the CFP exam. It's a huge accomplishment. Take care, Kathy. You know, this is such a tough one. Okay. Ideally, I would love it if you could keep working for 5 years. Okay? Now, that said, you're saying your health is not good, and that makes me nervous. So I don't like to be the person who starts saying, suck it up. And so I think that what I would say is this. Ideally, you'd work 5 more years. That way you got the money in the kids' college. The kids are off to college. That's good. But let's say you really do want to quit now. It's okay. So maybe you don't put $20,000 per kid into the college. So then you don't do that. And maybe the kids take out some loans. And maybe that's okay. I can't, these are real qualitative life decisions that are so hard. And, I think that if you're 43 and you could continue to work a little bit, doing something, not really tapping the pension, not doing anything, I think that would certainly be good. I feel like I want more information from you, except to say this. I think you know the answer. The answer is if you want to quit now and your health is being compromised, then you are probably not going to be able to contribute to the kids' college as much as you would hope for. That seems okay to me. It really does. I'm sure they'd like a mother who's healthy and sane. That could make a lot of sense to me. In terms of an asset allocation, you know what? I think it'd be worth it for you to just, play with some calculators online. Maybe look at some investment platforms. And maybe even for you, before you make this big decision, maybe the best thing for you to do would be to talk to an advisor. Maybe you ought to talk to these folks over at Facet Wealth or talk to an advisor who will be able to walk you through the upside and downside of this decision. Such a big one. I'd hate for you to take this decision and say, okay, this chick on the radio helped me make this decision. I really would, I'd like to be able to suggest to you that this deserves a lot more attention. And that may mean that you have to pay a few bucks today to get a deeper dive and a game plan going forward. At least then you'd really understand what you could be giving up and what the costs of this decision might be. And that might inform your decision and lead you to what I think makes sense for you and your family. All right? Okay, it's Jill on Money, ladies and gentlemen. And if you need more information, why don't you hop onto our website? It's called JillOnMoney.com. You can read, listen, watch, and find our resources. Don't forget, sign up for our free weekly newsletter. Okay, we'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You are back. It's Jill on Money. Woo! We're plowing through some emails. Mark's really bugging me about this. It's making me stay late, do all the emails. All right, I'm doing it. Let's get right on it, okay? Stephen writes, I like your style and what you're doing. Notice how I read that. I could have just skipped that and gone right to the question, but it made me feel good about myself for a second. Okay, I'm not sure if you can help me out. I've got an annuity that's reached the end of its accumulation stage, 10 years. I'm wondering what to do with it. Take the cash and invest, annuitize. I'm hoping to find someone who can review the contract and offer advice. My question for just an independent review and advice, what's a reasonable cost? Can you recommend someone? Okay. First of all, we don't know where you live, but there may be someone in your area who does this. You can get a fee-only financial planner to help you out. You can pay him by the hour. Hourlies can be anywhere from $250 to $500 or $600 an hour. I think what you're asking, though, might require more because is this really going to be part of a larger financial plan? In which case, you can pay a very small fraction, a couple $1,000 up to $10,000 or $12,000. It really depends on what you need. So I need to know more about other stuff in your life, and then I can help you out. If you're looking for a fee-only financial advisor, the best place to go is NAPFA, the National Association of Personal Financial Advisors, NAPFA.org. But tell us more about yourself so we can figure that out with you. Okay, Mike says, I'm 60 years old. I've saved $45,000 in a money market account, and it pays pretty little low interest. Okay, the money's for saving in emergencies, but I'd like to see it grow more or at least use it wisely. What would be the best use of this cash? Well, wait a minute. It's $45,000 that's for emergencies. You can't do much more with it. So this is what he wants to do. Should I pay off my mortgage? No, you should not, because then you now lost your liquidity. Should I take the money from the money market invest it in CDs? Well, I mean, you could take some of it. I don't understand what you're doing here. You're asking me these questions like, it's your emergency reserve fund. That means you have to keep it as safe. You can't save it. You can't spend it on your home renovations. You can't put in your 401k. You can't pay off your mortgage. The only thing you can do with an emergency reserve is keep it in a safe cash equivalent account. That means a checking, a savings, a money market, or a short-term CD. That's it. You cannot mess around with this. It is your emergency reserve fund. That's the most important thing. Okay. This is so much fun. Carolyn is a fan, and she is the audio person at a place which used to be, I think I can say all the name. Anyway, I mix audio in the control room at blank, and I love your segments. I bought your book when it came out. I listened to your podcast on my way to work. I have a question about Roth 401ks. I'm 31 years old. I'm single. I make a little over $130,000. I live in New York City. I understand now a Roth 401k would be attractive, but is my tax bracket too high? Where it would not make sense. So let us look, okay, at the tax brackets. Mark's already given me a thumbs down, but let me just remind you, Mark, that I know, not to me. Carolyn's tax bracket, she is single. She lives here in New York City, so she's in a 24% tax bracket. I think it's okay. I think do a Roth. I think the Roth is good. You're not making too much money, but I think a Roth is right for you. I think that at the 24%, I think you'd rather pay taxes at 24% at your age. First of all, also, by the way, nice income that you get there mixing audio. Mark, don't get any ideas. Okay, he's trying to get a new job. It's enough. All right. Here's a question about, can I recommend how you can get help with student loans or a forgiveness program for my daughter? If it's a federal loan, you've got to go to studentaid.edu? I think that's what it is. And you can look up loan forgiveness, but that's only for federal loans. And you can choose one of those game plans, but I'd like to know more about your daughter, and I would really like it, instead of you asking this question, if she could follow up. That would be really important to me. Oh, studentaid.ed.gov. There we go. Studentaid.ed.gov. William says, my wife is 66, I'm 74. She works and made over $15,000 in 2019. Can she fund her own Roth IRA? Yeah, $7,000. And then he wants to know, can she fund one for me for the non-working spouse for 2019? I think you can. I think that works, even though he's 74. I don't know if he's in. I think he can. I think you can. She definitely can do it for herself. I'm not sure about him because if he's already taking like RMDs, I guess so. I don't know. I think you can too. How much time do I have? Under one. Okay. Here's this guy, Gerald, who's got Jerry, who says he's got ETFs that have expense fees associated with them, wants to know who pays the fees. They are your fees. Anything that you have, expense ratios, they are all your fees, and they do not impact your tax liability, but you do have to pay them. All right. It's Jill on Money. When we return, more of your questions. Hop onto our website, JillOnMoney.com during the break. And why don't you favorite it? And then you can go back there whenever you want. We'll be right back. You're back. It's Jill on Money. We are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Okay, this is from Michael, who said, when interest rates were climbing, I owned short-term bond funds, floating rate fund, high-yield fund, and a multi-bond fund. And now I'm adjusting what I own. I'm thinking about a core and a core plus intermediate bond fund, a short-term fund, and to juice the yield a little bit, a multi-bond fund. 70 to 80% of my bond allocation, I'm thinking should go to intermediate core and core plus. Does it sound like a reasonable plan? I've got about $2.2 million invested, 70% equities. 70% equities? You go, man. He's 61. He says, I want to go to 65 equities. I'm thinking about divesting into commercial real estate. Any thoughts on this? No, I would not divest into commercial real estate via the crowdfunding approach. So no. Yes, to maybe reducing some of the risk in the portfolio. I don't want to overthink this, but I just want to say that if you just have essentially an intermediate core bond fund, I don't know what core plus fund is, but if it's a high yield fund, I'd be a little careful about that. I don't know if you are pulling money out of this account or not, but if you are, you obviously want to have a healthy cash position to get that money out when you need to get it out. And I don't know much more about you, but generally speaking, interest rates are low. I think it's fine to have just an intermediate term fund at this point. And if you need help on your allocation, I would suggest maybe thinking about a larger game plan. Maybe that might make you feel a little bit more secure. And before we go, here's a lovely note from Mitchell, who's 22 years old. He owns a collection of trading cards, and he doesn't play the game anymore. He says this collection's worth $23,000. I want to cash out now and go to college. I'm afraid the longer I wait, the lesser the value of my cards will be. But I have some which that are never going to be reprinted, blah, blah, blah. Do I cash out now or later? Let me be clear. Take the money. Cash out now. Don't forget to pay your taxes and go to school. That's what I'm telling you. No more risk. Great move. All right, that's it. That's the program. If you've got a financial question, you can always reach us all week long. Ask Jill at JillOnMoney.com, or you can always hop onto the website, JillOnMoney.com. You can get past shows. You can catch up with this one if you missed any part of it. You can get our great free weekly newsletter, and you can, of course, buy my book, The Dumb Things Smart People Do With Your Money. Their money. It's my title, Their Money. All right, we'll see you next week. Thanks for listening.